Hello everyone, how's it going? In this video, we're going to talk about SOFI Technologies trading under the ticker symbol SOFI. As one of the most volatile and bullish stocks during the peak of 2020 and 2021, SOFI has definitely been on most traders' radar. As one of the more developed fintech enterprises out there, SOFI accomplished something that most fintech companies either couldn't or didn't bother to do. They have a bank license. With that key document at hand, SOFI stands as one of the most fleshed out and comprehensive fintech companies that can actually replace traditional banks. With that being said, the most recent stock performance of SOFI has followed the market trend overall, which is down. Nevertheless, many people are still interested by eventually buying SOFI because it seems to have a very good potential. In today's video, we will take a look at SOFI and try to work out if you should be buying its shares. If you appreciate my content, please consider to drop a like, comment, and subscribe to my channel. Also, please check out the links in the description section as every help is greatly appreciated. SOFI has been targeting $6 during today's trading session and finally settled around $5.56, not far from yesterday's closing price. Overall, SOFI has been recovering at a decent rate given the circumstances. There are a lot of speculations around the company suggesting that 2023 may be a year of recovery and even glories, but it's still too soon in the year to tell whether this is going to be actually the case. What I know for sure is that the market is currently in the belief that the company's share price has fallen way too far, way too soon. There is also the possibility that this may not be the beginning of a full recovery, but a refusal just to go any further down. We have to remember that SOFI makes its money similar to a bank, and both high and low interest rates may benefit SOFI to various extents. Nevertheless, I believe that the region between $4.50 and $5 is a zone of strong support, and the bulls have taken back the control, at least in that area. What is your take on the company's short-term perspectives? Do you intend to increase or to decrease your position over the next few days and weeks? Please let me know down in the comments. SOFI is a fintech company that aims to become a virtual bank for users seeking more functionalities, flexibility, and competitive fees. As people's needs change over time regarding how and where they want to have access to their money, SOFI has identified this opportunity to do better than traditional banks, offering a scalable and consistent quality of service to its users and clients. Unlike many fintech companies offering different parts of what a bank does, it's worth pointing out that SOFI tries to bring all the services under one single umbrella platform to optimize the acquisition cost of each product. The company excels in areas of loan refinancing, personal banking, and wealth management. It's been recently under some selling pressure due to the student loan moratorium, and with that went most of its gains throughout the bullish period. However, it should be mentioned that despite the challenging environment of the economies around the world, it is not just bad news for financial institutions like SOFI. On one hand, people are more aware of financial fees, and many are looking to change this. SOFI might be one of the companies that can satisfy this need for better fees. This might be one of the reasons why, despite having a challenging investing environment, SOFI still manages to see its customers' deposits increasing over time. Another factor to consider is the ongoing quantitative tightening and inflation. When inflation is high due to external reasons, interest rates going up, increasing the bank's profits and decreasing their risks. After all, the purpose of a bank, or the purpose of a very developed fintech company, is to make money with people's deposits, and the current environment favors this tendency. Overall, SOFI has been growing on a year-to-year basis, although the progress has been slowed down somewhat in the recent month. This can be caused by the overall economic slowdown, which puts pressures on all businesses. Despite the unfavorable headwind, the fact that they still manage to grow is a testament of their brand recognition and the potential of the customer base. Due to regulatory and economic reasons, SoFi saw its student loan and home loan amounts decreased by 51% and 73%, but this has been compensated by the fact that personal loans increased by 71%, resulting in an overall increase of lending on a year-to-year basis. The long-term stock performance of SoFi has been like every other major growth stocks, which is downward. The stock has been down by 70% since the beginning of the year, mainly caused by the moratorium on a student loan, a major branch of its business model. The information that is currently available suggests that the moratorium is going to end early this year, meaning we should expect to see additional needs for student loan related businesses. With that being said, it's worth mentioning that personal loan has already filled the gap left by student loan and home loan combined, which does compensate the loss somewhat. What also brings down SoFi stock price and arguably keeps it down is the fact that it is a small boat in an ocean of bearishness. The Nasdaq, much like other major indexes around the world, have now lost most of the gains made during the period covering 2020 and 2022. This would suggest that the market has come back from the predictions by the end of 2019 regarding the world economy, which was already anticipating upcoming recessions, but without the worries of inflation and armed conflicts. This is why the probability of entering in a recession in 2023 and beyond is relatively high. This could bring the valuation of many securities, but especially growth stocks, even lower. So basically, what lies ahead for SoFi is the partial recovery of the student loan business, but also market-wide pressure for a lower valuation. With that being said, let's also take a look at the company's financials and see what the numbers tell us. In terms of profitability, SoFi is currently incurring a net loss from its operations if we include in the non-cash transactions and the non-operating expenses, which are mostly interest expenses and the equipment amortization. On the other hand, SoFi is yielding positive gross profit that grows across the past quarters, which is definitely something that is encouraging and shows the validity as well as the scalability of the business model. The one challenge that SoFi has is the cost control, but of course, given that a company is still in relative early stage, they would still emphasize growth over the bottom line. Another aspect that is very important is the leverage. SoFi has a high level of leverage accumulated over the quarters, which is relatively normal given the industry the company operates in. Nevertheless, we should be aware that the current level of debt may cause issues down the road, which is already showing somewhat given that the equity portion of SoFi has been reducing over the past 3 quarters. This is a sign that funds borrowed might not be used at their full capacity. The third aspect would be the cash flows that the operations bring in. And in this aspect, SoFi is doing a very decent job. The free cash flow and the cash flow from operations are positive, meaning the company has little incentive, if any, to go through dilutions. When we take a look at the company's ratios, it's not hard to see that SoFi has been lagging behind in terms of valuation, as this ratio seems to go down over time. It means that the company is not growing as fast as it should be, which is normal given the unfavorable market conditions and the student loan moratoriums. Nevertheless, we should be aware that SoFi is losing value on paper, and we should see the situation to be rectified somewhat in 2023 and beyond. Regarding the company's profitability ratios, what the numbers suggest is that things are being stabilized, and from some perspectives even going above the break-even line. In that sense, it is definitely an improvement over time. We should see whether SoFi can control its costs in the years to come, but for now, the gross margin as well as the EBITDA are what matters the most. We can also take a look at the shareholder composition of SoFi, because this may tell us whether the stock is molded for trading or investing, as well as the volatility of the stock. They are owned by institutions for about 35% of the current float. It's a significant percentage, of course, but it's still mostly in the hands of retail traders. It means that the stock price is expected to be more volatile than usual, and people tend to trade in and out of positions based on rumors and last-minute sentiments. With that being said, with 36% of the holding, I believe that we can invest in SOFI. This is a viable option. I would also point out that around 38% of the stock is owned by insiders, offering additional layers of reassurance to shareholders. One key behavioral difference between institutional and retail shareholders is their investment horizon. Institutional shareholders tend to take on long-term view with a focus on a company's fundamentals and growth prospects. They are also less likely to engage in short-term speculations. Institutional shareholders are also more active in the governance. They're more likely to vote on important decisions. Retail traders, on the other hand, tend to be far less active in that sense, and they're also less informed about the operations and decisions. As far as the short sentiment and the short squeeze potentials are concerned, SOFI currently has about 12% of the volume going to short, with 2.4 days for the coverage. This is a significant amount of shares shorting SOFI to be sure, but I believe that they are below the threshold beyond which I would consider that a short squeeze should be the primary motivation to buy those shares, so it's not the case here. Nevertheless, it's still worth considering that a lot of people think that the stock price is going to go through a lot of roller coasters before things get better. So regarding the short squeeze, it's important to note, even though the short interest is not guaranteed to happen, it's still a metric that's worth monitoring for investors. It's worth considering that short sellers may have valid reasons for their bearish sentiment, and that a short squeeze may not happen. I believe that SOFI is a stock in which we should invest in, meaning the short-term volatility may not matter, other than for a better entry point. In the meantime, I believe that the current price action is low enough for an initial entry and a confirmation that the current momentum is positive. Purchases should happen for the next 3 to 6 months. The maximum exposure I would recommend for SOFI is between 3 to 5% of your portfolio.